Welcome back to Invest Desk, your number one channel for cryptocurrency investing. My name is Syed. So I'm going to talk about why 92% of people lose money when they trade crypto. So let's dive right in. All right, so most people who actually get into crypto trading believe that with enough news, enough charts, and enough time in the market, they can beat the system and consistently make money. But moving forward, and even in 2026, the numbers tell a very different story. Now, more than 92%, like I mentioned, of crypto traders lose money on a regular basis. Now, this isn't a myth, a rumor, or a statistic thrown around the social media. This is the reality confirmed by multiple on-chain analytics firms, major exchanges, for example, and trading behavior research over the past 2 years. Now, what's even more shocking is that the reasons traders lose money, they have almost nothing to do with the market itself and everything to do with how traders think, react, and behave under pressure. So in this video, I'm breaking down the real reasons why 92% of the traders lose money, the traps they fall into without even realizing it, and what remaining 8% know that keeps them consistently profitable in the market designed to shake out the majority. So by the end of this video, you'll see the crypto markets differently, and you'll understand exactly what separates the winners from everyone else. All right, next, let's start by understanding the data itself. The 92% figure is not random. In 2026, for example, moving forward, several major exchanges released anonymous trader performance summaries. Now, these reports show that in both full or let's say bull or bear markets, right? In both markets, the vast majority of retail traders lose money. It didn't matter whether we looked at the long-term holders, day traders, or swing traders, or even social media investors, right? The common or the outcome was the same. Retail traders, for example, continuously or consistently underperformed the market. Yet, the most interesting part here is that the traders who acted the least, who made the fewest decisions, and who stayed in the market long term, tended to outperform everyone else. And that's exactly what I've been talking about on this channel for a very long time. Now, what these numbers really show is that more trading decisions you make, the more vulnerable you become to psychological mistakes. Now, in a fast-moving markets, for example, traders feel pressured to act instantly. They watch green candles and the red candles and assume every move requires a response. Now, but the constant reacting is exactly what destroys the performance. Next, let's take a look at the overtrading in the absence of a plan. Well, the most common reason crypto traders lose money, by the way, is overtrading. Now, most traders enter positions without a plan. They don't know what or where they will take the profit, where they will cut the losses, or what conditions must be met for a trade to be valid. Instead, they respond to hype, fear, or excitement. Now, over time, this lack of structure, by the way, leads to exhaustion, frustration, and emotional decision making. Now, winning traders basically trade far less than the average person expects. They wait for obvious setups, including of forced trades, right? So they approach trading like a business, where each action must have a purpose, a risk limit, and a measurable outcome. The average trader, by the way, however, jumps from one chart to the other, trying to chase the gains, not realizing they're just donating fees and liquidity to the market. Next, the real psychology, which is the real enemy, by the way. So crypto trading is more psychological than technical. The charts, indicators, and patterns matter, yes, but none of them work if a trader's emotions are in control. Fear, greed, uncertainty, impatience, hope, frustration, and revenge trading are some of the most destructive forces in the market. Fear forces traders to sell the bottom. Greed convinces them to hold too long and refuse to secure profit. Impatience leads to bad entries. And hope, of course, keeps them in long positions instead of cutting losses. Now, traders get trapped in emotional loops, by the way. They enter a position too early, panic as the price dips, then exit at the bottom. A few hours later, the price pumps again, and then they chase the move, entering near the top. Now, over weeks and months, this cycle wipes out entire portfolios, but successful traders feel the same emotions, but they never allow feelings to dictate decisions. This consistency comes from discipline, not confidence. All right, next, let's talk about the dangers of leverage. Another major cause of losses, by the way, is leverage. Well, leverage allows traders to control large positions with small amounts of capital, but it also magnifies risks to extreme levels. Many traders use leverage without understanding liquidation levels and funding rates, volatility spikes, or why price movements on exchanges sometimes intentionally trigger liquidations. So the leverage has become even more dangerous because market structure has evolved. Algorithms respond faster, liquidation cascades basically occur more efficiently. And exchanges profit when traders take reckless leverage. Now, most retail traders use margin as a shortcut to amplify gains, but what it really amplifies is emotional stress. Liquidations occur faster than traders can emotionally react, which is why most leverage traders lose long before the prediction has a chance to play out. The 8% who are profitable avoid high leverage entirely or use it sparingly under strict conditions. Next, let's talk about chasing hype and social media signals, right? So another reason 92% of the traders lose is the endless chase for hype coins. Now, social media accelerates this problem. Influencers, pump groups, trending hashtags, and viral videos push traders into coins they don't understand. Now, these coins often pump rapidly because insiders accumulate early, and retail traders see the excitement and enter late, basically unaware that the insiders are already selling. This is why most traders buy tops and sell bottoms. Now, by the time a coin becomes viral, its biggest move is already over. The minority of traders who consistently win do the opposite. They buy when sentiment is low and nobody's watching. They exit when the crowds show up. All right, next, poor risk management. Now, many traders have no risk management at all. Now, what they do is they bet too much on a single coin, hold too few assets, and allow emotions to dictate their position sizes. Now, when losses occur, by the way, they add more money trying to get even. Without a plan to limit losses, one bad trade can wipe out months of gains. Now, winning traders prioritize survival above everything else. They risk small amounts of relative to their capital, by the way, and they use stop losses. They take partial profits. They secure gains instead of letting them evaporate. And most importantly, they understand that preserving capital is more important than chasing large wins. All right, let's talk about next, lack of patience and long-term strategy. So patience is, of course, one of the rarest skills in crypto trading. Most retail traders basically want fast results, immediate gains, and instant confirmation. They move from strategy to strategy looking for one of that eliminates losers. But the truth is that losses are part of the process. Winning traders don't abandon strategies at the first sign of difficulty. They stay consistent and treat trading like a long-term craft. They understand market cycles, accumulation periods, and long-term narratives. Most traders lose not because they lack intelligence, but because they lack patience. All right, next, let's talk about what the winning 8% do differently. And this is important. So the 8% who consistently profit follow a very different path. They don't chase trends. They don't overtrade. They focus on a few assets and learn how those markets behave. They research well. And that's exactly what InvestDesk does for you right here. And that's what I do, provide the research. Now, they wait for the high probability setups. They control their emotions. They focus on risk, not reward. And most importantly, they remain consistent. They understand that trading isn't about winning every trade, it's about surviving long enough for good trades to come. All right. Next, let's talk about what's new for 2026, AI-driven liquidation traps. One of the new challenges is the rise of AI-driven trading systems that monitor and exploit retail behavior. So exchanges and institutional traders basically now use machine learning systems to identify where a retail trader places their stop losses, where people are likely to be liquidated, and where the majority of the traders are positioned. And price movements often appear random, but in reality, algorithms are pushing the market towards liquidity zones. Now, this market, emotional trading, is even more dangerous. Without a structured plan, traders basically fall victim to precision liquidation waves, for example, designed to remove predictable players from the market. All right, next, what's new for 2026? The regulatory pressures and hidden fees. Well, regulations is also playing an important role in the trading profitability. Some regions have introduced rules on leverage, pattern day trading, for example, behavior, and high-frequency retail activity. Fees in certain markets have quietly increased. Spread manipulation is more noticeable during high-volatility events. Now, all of this chips away at trader profits. The traders who survive adapt quickly. They understand regional rules, fee structures, and liquidity conditions. The majority ignore these things and pay the price. All right, next. So if you found this video helpful, but first let me give you the key takeaways. One of the most important lessons from all of this is that crypto trading is not just about picking the right coins. It is about controlling behavior, managing risk, understanding market structure, and developing patience. Traders basically lose money not because the market is unbeatable, but because they enter without a plan. They allow emotions to dictate decisions, and they look for shortcuts instead of building long-term skills. The traders who consistently win understand the success comes from discipline, routine, and resisting the urge to chase every move. They basically protect their capital, they wait for high profitability setups, and then they stay focused on survival rather than instant profit. If you take anything away from this video, by the way, it is consistency, patience, and emotional control matter for more than finding the next big coin. So, with this, thanks for watching. Thanks for being at InvestDesk. If you like this video, make sure you give it a thumbs up, hit the subscribe button, and the bell notification so you get notified once the new video hits. My name is Syed. I'll see you next time.